Hello, hello. Welcome to Clear Money Talk. I am your host, CEO and founder of Clear Financial Partners, Tim Clairmont, and as always, here with Mr. Tyler Andrews.
Thank you, Tim, for the introduction. You know, I'm curious who is like a loyalist listener. They're like, Tim, we know it's you, we know it's Tyler, and then we got newbies on the podcast. Like, okay, I appreciate the introduction. So if it's your first time, thank you. If it's your second time, thank you. If it's your 100th time, thank you for that too.
Thank you.
Yes.
If it's your 100th time. So the loyalists are much appreciated.
Yeah.
And the first timers, hopefully you become a loyalist. If you're watching us on YouTube, you will see this is a new setup. We're actually facing the camera instead of this whole sideways thing. So I'm, it's just
What do you think of it? A little bit different. Kind of like it.
I kind of like it too. It's hard because I get used to looking at you all the time. And so now I don't get to look at you as much. So I got to look at the camera instead. So it's probably better. The audience probably appreciates that, I would think. I mean, I think I'd look better in the front than the side anyway. So it's probably okay.
Everyone's got their best.
Everybody does.
Some it's the front, some it's the back of their head.
Yeah. No, it's good. It is what it is. Anyway, welcome to Clear Money Talk. I have no idea what the topic is. That's the way it is for your first-time listeners out there. I don't get to find out the topic in advance. You actually know it before I do. You know it based on the description of this particular episode that you clicked on when you decided to listen. And I'm going to find out what that question is. Tyler's got it prepped up for me, and then he'll ask me the question, and we'll start going. We'll start answering these frequently asked questions by clients that kind of pop up, and
This is going to be a big one. A lot of people are asking this more than ever, I feel like. And we're caffeinated. We're ready to share this with all of you. So you ready?
Yeah, I think so. Let's go.
We're at the starting line. Here we go. Topic of the day, what should you do when the market hits record highs?
Ooh. Okay, cool.
We get this asked a lot. So it's September of 2025 as we're recording this podcast right now. Earlier this month, S&P 500, one of the most notable benchmarks that people use for the equity markets, hit another high. So many times people come to us, investors, clients, friends, neighbors, all that stuff, and they say, hey, market's at an all-time high, Tim, Tyler. Is it the right time to invest? Should I wait? Should I wait for a dip? Should I do something else? And it's a very common question to ask, and it's a great question to ask as well. So I thought it'd be a fun topic to talk about and give our opinions, our thoughts, what we've seen in practice, and go from there.
Cool.
What do you think?
Yeah, no, I love it. I love the topic. Love the thought. A lot of people have that question, and they actually don't think to necessarily ask the question, but I feel like it's implicit. It's something that they're always curious about, but we don't often get it articulated to us. So I'm glad we're actually articulating it. What should I do if the market hits all-time highs? Let's address that, at least with our opinion. At the end of the day, that is all this is. I mean, we're clearly educated, competent financial advisors that have been doing this for decades. But
handsome.
Handsome. Oh, that's nice. Good perk. Yeah, that's right. Yeah, handsome. Tyler's more handsome than I am. He's got the youth on his side. Anyway, dealing with you got me all distracted now. I'm just thinking about the handsomeness now as a factor. Thanks for that. Dealing with what to do with the market as highs is. The biggest reason why people are asking that question is typically because they want to know, should I buy now or should I wait until the market theoretically drops and get a better deal? Is it still a good price for me to buy into the stock market when it's at an all-time high? And that's one element of this question, but it's not the only element of this question, because the question is, what should I do when the market's at an all-time high? And frankly, the biggest answer to that immediately came out of my gut as soon as I heard that question was, well, that is a perfect time to seriously reevaluate diversification. And the reason for that is because when the market's at a high, your stocks are at all-time highs, which means it's okay. Let me ask you this question. When do you want to sell if you own stocks? Do you want to sell when they're low, or do you want to sell when they're high? Hopefully you're answering that, sell when they're high, because that's when they're worth the most amount of money. So in order to do a rebalance or a reallocation or strategize a diversification of your overall portfolio, you oftentimes need to sell some of the things you currently own. And if you need to sell those things, you want to get the best price you can for them. So selling when the market's at a peak so that you can redistribute the wealth exactly the way you want it from a strategic standpoint is a key move that makes a lot of sense when the market's at a peak. And that was my gut check reaction. Is like, that's definitely something I would seriously consider. Of course, you have to pay attention to the tax implications associated with that. And you might want to give some real consideration to a strategy called tax loss harvesting, or also known as tax deduction creation, by buying and repurchasing some of the positions selling and repurchasing some of the positions you currently have with a lag time in between to avoid a wash sale so that you can get some tax deductions that you can benefit from this year in 2025 for your tax purposes. And it is typically something you do right near the end of the year. So we're near the end of the year when you're hearing this. It could be a really good strategy for you to give consideration to. Back to the main question, though. You want to know, should you buy? I really think that's typically the reason why most people have clicked this show. And my answer to that is I do not recommend that you wait for the market to drop. There are many instances historically where the market has been at an all-time high and it doesn't go down. It just keeps going higher. And yes, eventually it will go down. That's the nature of the market. But who's to say it's at the peak now and it's going to go down soon? We may never see the market lower than it is today. It could keep going up, and then whatever the next dip is might not go down as low as it currently is. And there's just no way to know that. So fundamentally, there's some concept called modern portfolio theory. And modern portfolio theory, you can Google it or AI check it on ChatGPT or Claude or whatever your AI preference is, or whatever you're utilizing for purposes of research at this nowadays. But modern portfolio theory is this idea that it's about asset allocation. It's about how you have your portfolio diversified, how you have it invested, what positions you're holding. That will determine 93% or more of your success in terms of your growth in your portfolio. And if that's the case, you would just want to be allocated correctly. The belief is that it's about time in the market, not timing the market. So I would argue this could be the best time to buy, even if the market is at an all-time high. I don't know. I don't know if the market's going to drop in the very near future. If you seem to have a crystal ball that's more functional than mine, that would be great. Please let us know. But in general, I'm not a big fan of trying to time the market. I think that you need to think about how long is it going to be before you're going to touch the money that you invest. If you've got 5 years, 10 years, 25, 30 years before you're going to touch that money, ask yourself this question. Do you think that the value of those securities you're going to invest in will be greater when you plan on touching the money in 5 years, 10 years, 25 years than it is today? And if you feel like the answer to that's a yes, then you probably shouldn't wait to invest. That's my thoughts.
Yeah, I think there's a lot of natural fears that come along with highs, doing the air quotes for highs, because people are worried that they have the freeze moment that am I purchasing at the top, and then the investment's going to go back down and then never reach that top again, and I'm going to forever lose money. And a statistic, because statistics are nice, the S&P 500, again, talking about one of the most notable benchmarks or indexes that exist, has reached 1,400 unique individual highs since 1957.
Wow.
So
okay.
if you think about that, that's 1,400 times people could have said, hey, it's at an all-time high, I don't want to invest.
Wow.
And that could have been a huge opportunity cost to never have invested, just waiting along the sidelines that entire time, waiting for it to drop below that last high, and it never did.
Wow.
I mean, think about the high in 1965 or 1972 or 1981. Like, those are all much lower than what it's at right now.
Yeah.
And that helps to kind of put it in perspective. At least it did for me, because I didn't know that quote before I researched it before this, and I thought that was pretty cool.
Yeah, that is cool.
So,
I wonder, I bet you could research very quickly. Of the 1,400 highs, how many times did the market drop lower than those previous highs within 6 months, 2 years, 5 years? I mean, you could research that kind of thing. But remember, just because the market might theoretically dip at some point to a price that's lower than they're currently at now, is that the window you're going to just nail perfectly? Are you really watching the market so closely that as soon as it drops just a little bit lower than it currently is, that's when you're going to buy? Well, no, you're going to have the same question. You're going to be like, well, maybe it's still going to drop further. And then you just keep speculating. Oh, it's probably going to drop more. It's going to drop more. And then you watch it. You end up not doing anything. And then, oh, no, the market jumps back up and you're above what the current high is anyway, and you didn't take any action. And if you didn't take action, well, none of this mattered anyway. So why do you want to spend so much time focusing on that individual element of the pricing and the timing when it's proven by most economists and theorists in this respect that it's not something you can do with any kind of consistency? If somebody could do it with consistency over and over and over again and time the market accurately like that, I think we'd know about it by now.
Yeah, that's well said. And I think there's the hidden cost of waiting too.
Yeah.
There's the hidden cost of saying, well, I got this cash, I'm going to wait for an opportunistic time to purchase into whatever I want to purchase. And there's hidden costs with that. It might feel safe, it might feel comfortable knowing that you have that available, your cash flush, if you will. But what about inflation, eroding purchasing power? What about historically speaking, the markets? I mean, if you look at the markets over a long period of time, if you miss just like a couple weeks of the most important trading days in the major equity markets, that can like cut your returns in half over a like 20 or 30 year period of time. And you can do your own research to validate that. But the most important trading days can, if you miss those because you were waiting for some magical time to present itself, can severely impact your long-term performance, which is another hidden cost of waiting.
It's a really, really well, said statement. It requires additional emphasis. If you Google that or search on the internet, search this phrase. Essentially, it should be able to give you this information. How many of the best days in the market do I need to miss in order to earn X as far as a rate of return, or in order to earn, and then pick whatever your X is. We've seen these charts in the past, and Tyler's right on point. Like if you miss, I think it's like the 10 best days of the market in the last 10 years, you end up with less than an average annual rate of return, less than bonds. Like you would have been better off in bonds, and bond rate of returns are well below inflation in general on the majority of the average aggregate bond indexes. So the point is, if you're trying to beat inflation, you're trying to keep your purchasing power and retain your value of your securities that you're investing in. You've got to be in the market for those 10 days. You got to make sure you don't miss one of them, or you don't miss 10 of them, and that's well pointed out.
Yeah. Thank you for that. Thank you for expanding upon it too. So let's talk about maybe why timing doesn't work well. I think a lot of investors, especially the younger investors or people that have maybe been DIYing it for a long period of time and have had success with timing the market in certain opportunities. Let's maybe talk about why that isn't a good long-term strategy, because I will say that it's hard to continue to repeatedly time the market well. Even the professionals mess up. I mean, portfolio managers with CFA designations, all the levels you can achieve, decades and decades of experience, being paid large salaries to do what they do for mutual fund providers, hedge funds, and all that, still miss timing the market properly. Yeah. So, if you're sitting behind the camera and you're like, I time it well all the time, give us a call.
Yeah.
We'd love to talk to you. But anyways, what are your thoughts?
Yeah, well, I mean, everybody, if you, look, I'm not a big gambler, but if you gamble, you only remember very well your wins. You might remember catastrophic losses, but all of the little losses along the way, you don't remember those. They don't stick out in your head. And the market timing issue is very much along those lines. You might if you're doing a lot of investing on a regular basis, you might have a lot of situations where if you were waiting, you missed out, but you don't talk about those opportunity costs that you incurred on every one of those purchases you were a little late on, or that you didn't buy at the lower price when you could have bought at that lower price. Instead, you just talk about your wins, or you only think about your wins. And if anything, think about it this way. If the market were to drop and you predicted it successfully, you got out of the market, then the market dropped, and then you got in at the bottom, right? The odds of you doing that are extremely low. I've had a handful of clients that have been so pessimistic for such long periods of time that they've gotten out of the market and successfully got out of the market right before a small decline. And they were so proud that they had gotten out of the market before that small decline. But do you think they actually got back in when the market was down? No, they were scared, senseless. They thought the market was still going to go worse. By the time the market recovered past it, they never had invested in the first place, so they missed the downturn. On the other hand, those who timed successfully and said, "Hey, the market's low right now. I'm going to buy right now," and then they made a bunch of money. The market takes off right after that. There's a handful of clients like that. But those are actually the dangerous ones, because you time successfully once like that, and you start to think you can do it all the time. And as Tyler said, I don't know anyone that can do it consistently over and over and over again. It's nice to get lucky, but if you go to Vegas and you get lucky, you hit a slot machine or something like that, and you hit a streak at blackjack or whatever it is, and you win, the house is counting on you coming back and gambling and losing after that. And that's the nature of what happens most of the time. And people don't talk about that. They just talk about that really great big win they had before. So, this isn't gambling when you're investing. It's different. There's a different level of risk involved. You're purchasing something that you're hoping is going to appreciate in value over time. And you just need to feel good about what you're buying, what you're paying for it, and that you're going to hold it long enough that it's worth purchasing it and then selling it at some point down the road when you're ready.
Awesome. Yeah. Let's talk about the next thing I want to talk about here. Subtopic is, okay, Tim, Tyler, I get it. I shouldn't be timing the market. It's better to invest yesterday than waiting for today or the next day. What are maybe some strategies to ease me into it, to make me feel better about the situation? Yes, the market is at highs right now. I understand I need to invest. But how do I do that and still maybe manage risk? Not totally mitigate it. There's always risk involved with investing, potential for gains, potential for losses, et cetera, and so forth, disclosures made. But how do I do the best I can to increase my odds of returns but mitigate risk at the same point? So I'm going to just give some strategies that we use, and maybe you can expound on them.
Sure.
Sound good?
Yeah, happy to do that.
Dollar cost averaging.
Yeah, dollar. I felt like you were like just teeing that up.
Yeah.
So dollar cost averaging, absolutely.
Get your driver out and just knock it down the fairway.
Yeah. So dollar cost. If you've heard of dollar cost averaging, you already know what I'm talking about. Well, maybe not. Maybe you've heard of it, but you don't really know what it is. If you haven't heard about it, it's the idea that you're going to invest a specific dollar amount, fixed dollar amount typically, on a regular basis, like without thinking about where the market's at. So imagine that your 401k, for example, through your employer, or any kind of qualified retirement plan account through work, if you contribute every single month into that plan, you're purchasing at whatever the price is that the market is selling at that time. You're not thinking about it. It's just a fixed dollar amount that goes in on a regular basis. If you do that every single month or every quarter, I mean, there's even ways to dollar cost average over larger gaps. But then what happens is when the market's lower, the same amount of money naturally buys more shares. So think of it this way: if you put in $1,000 a month, and the stock that you were purchasing, or the portfolio you're purchasing, hopefully it's a diversified portfolio, was selling for $100 a share. So that means you just purchased 10 shares at $1,000 with a $1,000 investment. Well, the next month, let's say the price drops, and the price drops down to $80 a share, and you put in that same $1,000. Well, you just purchased more than 10 shares now, right? You've just purchased approximately 12 and a half shares. So you're looking at, you just got 12 and a half shares at $80 per share. You got 10 shares at $100 per share. When you go to sell those shares later, assuming it's worth 120 or something like that, you have more shares that you picked up at a lower price per share. So you actually naturally accumulated more shares at a lower cost by taking advantage of dollar cost averaging. So all you have to do is just put in a fixed dollar amount on a regular basis without paying attention. And if the market goes down, you'll naturally purchase more. But you have to make sure you're in the right stuff too, and make sure that you feel good about what you're investing in.
Great job. And that leads us naturally to the next one.
Okay.
Diversification.
Diversification. Any one stock has a chance of going up significantly or going down completely to zero. That's the problem with picking one stock. Even if you pick a diversified, theoretically, portfolio of 5 to 10 stocks, it's not really that diversified. It's only 5 to 10 companies. There are thousands of companies all over the world, and there are so many easy ways for you to be invested in thousands of companies with a very small amount of money. That's the nature of how mutual funds work. That's the nature of how these kind of diversified portfolios work, where you put your money in as part of a pool, and then the investment portfolio manager for that pool chooses all those stocks and what to buy, when to buy, what to sell, when to sell, as well as those bonds and all the other investment accounts that are out there, or investment choices they make. And you just get to participate in the overall aggregate growth or loss that occurs in that portfolio, that pool of assets. The fact that you can invest in a pool like that and benefit from diversification is a pretty neat innovation. It's really just taken place in the last 100 years or so. When mutual funds were born in the early 1900s, it was revolutionary. And now we take it for granted. We don't even think much about it. Your 401ks, all that stuff is pretty much invested in mutual funds when you're investing in your retirement accounts. And now there are other portfolios you can invest in that are similar to mutual funds, like variable annuities that can have what are called sub-accounts, perform similar to mutual funds. They're not technically mutual funds. They're diversified pools of assets that are managed by a portfolio manager, but they're inside of an insurance contract instead of outside of an insurance contract. And there are other examples of that as well that exist out there. But being in a diversified pool of assets means that if a few of those companies don't do very well, they go belly up, for example, hopefully all of the other hundreds of companies are doing okay, or in and if a few of them are doing really well, you'll get to participate in those as well.
Yep. Last one I wanted to talk about was focusing on the plan, not the headlines.
Yeah, fair.
Yeah.
You got to think about when you're going to touch your money and how long you have. It's about, again, time in the market, not timing the market. So, think about your plan. We take what we call a bucket planning approach for clients that are in the retirement years, where you take much less risk with the money you're going to touch in the next 0 to 3 years. Take a little bit of risk on the money you're going to touch in 3 to 10 years because you have a little bit of time on it, so you can take a little more risk, try to get a little higher return, but don't want to be crazy with it. And then more risk with the portfolio that we're going to touch in the 10 plus year range. We refer to it as your now bucket, your soon bucket, and your later bucket. And taking that kind of an approach and diversifying your risk based on your time frame for when you're going to touch the money is another way that you can tactfully make some adjustments in your overall portfolio. If you are in I would say, let's say between the ages of 53 and 53 to 63, you are in a critical phase of life where you are likely in the preservation phase. You're transitioned out of accumulation. You've been built up the money you've built. Now you got to preserve it. You got to make sure it's safe, that you don't lose it. Another thing to consider doing when the market's at all-time highs is pull the trigger on that preservation strategy. It's time to secure what you've got. You've already made a really good decision in building the wealth that you've built. Not only diversifying amongst your investments and maybe eliminating some over-concentration you might have in a few positions, but also just taking stock of the fact that you might be closer to retirement now than you ever have been, and it might not be that far away. And if it's coming up pretty soon, making sure that your assets you've worked so hard to build up don't go away is worth considering.
Yeah, absolutely. I mean, that's our approach. We focus on clarity and discipline over guesswork. It shouldn't be guesswork. I hope this works out. We have other podcasts actually talking about that. Do you actually have a plan, or are you just hoping it works out?
That's right.
Is another one that we recorded.
That was a popular one. There were a lot of people that
it was
said that one. Yeah.
It was. So I think that one of the biggest things I can emphasize is that the question shouldn't be, is the market at a high? But the question should be, will my plan work regardless of what the market does at the end of the day?
Ooh, yeah, that's a good one.
If you can confidently say yes, then you shouldn't be worrying, day in and day out, if the market's at an all-time high or not, or if it's a low or what. Because if you have a plan that can survive the ups and the downs and the whoops and the bounds and all this stuff in between, then you
whoops and the bounds.
Shouldn't have to worry about
I like that.
So
I haven't heard that.
And that's what we help investors and clients with every day.
That's good.
So
that's good. Whoop whoop.
Yep. Whoops and the bounds.
That's good. Okay. All right. Well, I feel pretty good about the answers to this question so far. Why don't we do the answer? So, Tyler, give it a shot.
Take it away.
Give it a shot.
Would love to.
Take it away.
Tonight, topic of the day, we talked about what should you do when the market hits record highs. So the first thing we talked about is the fear of highs. A lot of investors naturally have the fear that when markets hit new highs, which can't avoid it. You hear it on the news, you hear it on social media, you look at the major indices, and it's clear when they hit new highs. And that can present a lot of concern with many investors. It's now the right time to invest. Am I going to invest and then lose my shorts because the market's going to go down shortly after? And it's a natural fear to have. So we're not saying that if you have that fear that you're wrong. It's very natural and normal to feel that way. We talked about why people feel that way, how to find solutions around that to make yourself feel better about it. And obviously at the end of the day, no one knows what the market's going to do. It can go up, go down, can do those whoops and bounds that I was just talking about that Tim loves so much. And as an example, we talked about how the S&P 500 has hit 1,400 unique individual highs since 1957. So that kind of puts in perspective how many times the market has hit highs in the last
68 years.
68 years. Thank you, Tim.
You're welcome.
That is very nerdy that you're able to do that quick.
No, that's pretty quick. It's 1,400 out of 68 years. Wow.
Yeah.
That's pretty cool.
So it's pretty cool. So talked about the fear of highs. We talked about the cost of waiting. Biggest cost of waiting is sitting on cash and inflation, eroding purchasing power. Also, we talked about how missing just the 10 most crucial trading days in the equity markets can account for your rate of return severely, even cut in half over a period of a couple decades. So being out of the market just for a quick stint of time, because you're trying to wait and time it properly, can severely reduce your average rate of return over a long period of time. So that's one of the hidden costs of waiting as well. And we talked about how market timing usually doesn't work for most investors. I can't time the market accurately, at least not 100% of the time, and that's not what we recommend doing anyways. even the professionals, the CFAs, the portfolio managers, the hedge fund managers, they try to time the market and they can't do it consistently time in and time out. So if that doesn't tee it up to present to you that it's hard to do, I don't know what will. And then Tim did a great job of talking about some strategies to ease the fear. So some of the most common ones that we talk to clients about, and that are some of the most historically proven strategies to help mitigate is now the right time or the wrong time to buy, is dollar cost averaging, diversification, and focusing on your plan. If you have a plan, you should weather the storm, whether the market's at highs or if it's at lows. And we talked about clarity and discipline over guesswork. And we also talked about that you shouldn't be asking the question of, is the market at an all-time high? But you should be asking, is my plan able to weather the storm, whether the market's at a high or a low? And if you can implement those things and you can focus on the course and the plan, I think you can tee yourself up for the most success possible. Obviously, there's a lot of variables and unknowns that will always present themselves, but
That's awesome.
that's why you should teamwork. Team up with somebody good, so that way you can weather it with them.
Yeah,
That's what we do.
That's what we do.
what
Clear
we
Financial
do.
Partners. That's right. That was really good, dude. Knuckle bumps, yeah.
Thank you.
I hope, maybe Jeremy can put some kind of a pizzazz moment there. That was
lanes or something.
that won't make any sense to the audio listeners, but those
why
that
you
are
gotta watch
watching
the
it on
video.
YouTube, you get to see us physically actually do stuff like the knuckle bump I just gave Tyler. So anyway, that's great. Well done. I think you did just the answer well. So it's time to move on to the fun stuff and wrap us up.
He's ready for some trivia.
Yeah, that's what's coming.
Okay,
Stump the
so
nerds.
this is complete 180 from what we talked about. But
Okay,
trivia of the day is which fruit holds the record for being the most consumed in the world?
Fruit. Which fruit holds the record for most consumed in the world?
That's right. I got multiple choice if you want it.
Let me just kind of think through these out loud.
Okay.
So we got bananas, and you got apples, and you got pears, and you got raisins, which I actually really like raisins. Grapes. Oh, grapes, because of wine. I'm gonna go with grapes.
Gonna go with grapes. That was a choice.
Yeah.
Was it the right choice?
No, really? Well, because there's a lot of people that drink a lot of wine. So if you count the wine and the number of grapes that go into the wine,
You're onto something.
I'm just saying, at the end of the day,
You're onto something.
I think that might be more than any other fruit. But okay, what's the right answer?
Mangoes.
Mangoes? I don't know. What?
Mangoes.
I don't believe that at all. Maybe if you had to eat
Mangoes
raw
are the most
fruit.
widely consumed fruit globally, sometimes called the king of fruits.
Okay, all right. I mean, mangoes are really good.
Mangoes are really good.
They're solid, but I mean, when have you seen somebody in the United States recently just
Well, I mean,
whip
we're
out a mango?
talking globally though. so-
No, I know,
Yeah.
that's fair. I'm just saying, but from our experience here in the United
That's fair.
States, like when's the last time you saw somebody whip out a mango and be like, yeah, man, I'm gonna go to town? It's like, that's
I'm gonna go
it's not
house
a real
this
common.
mango.
It is a common thing in a lot of other cultures, though. I certainly have traveled.
Bananas,
around to see that.
apples, grapes.
Yeah, that's good. That's
mangoes.
good. Okay, all right. I think if you count the grapes that go into making wine, I think I might win. But
That's fair.
I'll give you mangoes.
I'll give you that.
I'll give you mangoes.
It's good to have an argument to the stat.
Yeah, there you go. All right. Well, thank you so much for joining us on Clear Money Talk. I hope you had as much fun as we did, or
We had
at
a
least
great
half
time.
as much fun. If you had half as much fun as we did, you had a pretty good time.
That's
because we had a
fair.
lot of fun. So
That's fair.
thanks for joining us. Until next time, and call us. You don't be a stranger. If you're interested, need some help, second opinion, you want to diversify your portfolio, talk about just looking at your retirement income plan, making sure you're optimizing your income streams for yourselves, minimizing your taxes. I think that's what we do. 503-579-1000 at Clear Financial Partners, or you can check us out on the internet at clearfp.com.
Well said. Yeah, I mean, we have a good time with what we do. So, and we're pretty smart when it comes to that stuff too. So, if you want to team up with some people that have a lot of experience and knowledge, but they also know how to have a good time, and
That's our bag.
it might be the right one to call.
That's my bag, baby.
And with that,
Until next time, thank you for joining us on Clear Money Talk.
see you.
Tim Clairmont and Tyler Andrews are investment advisor representatives offering securities and advisory services through Cetere Wealth Services, LLC, member FINRA SIPC. Advisory services offered through Cetere Investment Advisors, LLC, a registered investment advisor. Cetere is under separate ownership from any other named entity. The views depicted in this material are for information purposes only and are not necessarily those of Cetere Wealth Services, LLC. They should not be considered specific advice or recommendations for any individual. Cetere Wealth Services, LLC exclusively provides investment products and services through its representatives. Although Although Cetere does not provide tax or legal advice or supervise tax, accounting, or legal services, Cetere representatives may offer these services through their independent outside business. This information is not intended as tax or legal advice. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. Examples referenced are hypothetical only and do not represent the actual performance of any particular investments. Converting from a traditional IRA to a Roth IRA is a taxable event. A Roth IRA offers tax-free withdrawals on taxable contributions. To qualify for the tax-free and penalty-free withdrawal or earnings, a Roth IRA must be in place for at least 5 tax years, and the distribution must take place after age 59 and a half or due to death, disability, or a first-time home purchase, up to a $10,000 lifetime maximum. Depending on state law, Roth IRA distributions may be subject to state taxes. Distributions from traditional IRAs and employer-sponsored retirement plans are taxed as ordinary income and, if taken prior to reaching age 59 and a half, may be subject to an additional 10% IRS tax penalty. Investors should consider the investment objectives, risks and charges, and expenses of mutual funds and ETFs carefully before investing. The prospectus, which contains this and other information about the funds and ETFs, can be obtained directly from the company or from your financial professional. The prospectus should be read carefully before investing or sending money. A diversified portfolio does not assure a profit or protect against loss in a declining market. Dollar cost averaging will not guarantee a profit or protect you from loss, but may reduce your average cost per share in a fluctuating market. Investors cannot invest directly in indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and the fees and expenses associated with investing. Although it is possible to have guaranteed income for life with a fixed annuity, there is no assurance that this income will keep up with inflation. There is a surrender charge imposed generally during the first 5 to 7 years or during the rate guarantee period. There is a surrender charge imposed generally during the first 5 to 7 years that you own the contract. Withdrawals prior to age 59 and a half may result in a 10% IRS tax penalty in addition to any ordinary income tax. The guarantee of the annuity is backed by the financial strength of the underlying insurance company. Investment subaccount values will fluctuate with changes in market conditions. An investment in a variable annuity involves investment risk, including possible loss of principal. Variable annuities are designed for long-term investing. The contract, when redeemed, may be worth more or less than the total amount invested. Variable annuities are subject to insurance-related charges, including mortality and expense charges, administrative fees, and the expenses associated with the underlying subaccounts. Investors should consider the investment objectives, risks, and charges and expenses of the variable annuity carefully before investing. The prospectus contains this and other information about the variable annuity. Contact Clear Financial Partners at info@clearfp.com or 503-579-1000 to obtain a prospectus, which should be read carefully before investing or sending money. The cost and availability of life insurance depend on factors such as age, health, and the type and amount of insurance purchased. Before implementing a strategy involving life insurance, it would be prudent to make sure that you are insurable by having the policy approved. As with most financial decisions, there are expenses associated with the purchase of life insurance. Policies commonly have mortality and expense charges. In addition, if a policy is surrendered prematurely, there may be surrender charges and income tax implications. The target date of a target date fund may be a useful starting point in selecting a fund, but investors should not rely solely on the date when choosing a fund or deciding to remain invested in one. Investors should consider funds' asset allocation over the whole life of the fund. Often, target date funds invest in other mutual funds, and fees may be charged by both the target date fund and the underlying mutual funds. The principal value of these funds is not guaranteed at any time, including at the target date. Cetere does not offer any direct investments, endorsements, or advice as it relates to Bitcoin or any other cryptocurrency. This is for informational purposes only. Bank certificate of deposits are insured by an agency of the federal government and offer a fixed rate of return, whereas both the principal and yield of investment securities will fluctuate with changes in market conditions. Clear Financial Partners is located at 15573 Bangui Road, Suite 100, Lake Oswego, Oregon 97035. For more information, please call us at 503-579-1000.